so the market losing a bit of ground today, but not much movement, still trading sideways, still a question of the currency, still a question of growth, still a question of inflation. What's needed to really just give this market some impetus?
What's actually really needed is for the institutional investors, your fund managers, and rational investors to move into the market and bring in the much needed demand that is needed. What is lacking in the market right now is it's more of a seller's market. People are really not in for it, and institutional investors are really moved most of their funds into the money markets, into the treasury bonds, bills and bonds. So what is actually needed is a group of rational investors that can come and start cherry picking stocks and giving the much needed demand that is needed in the market.
All right, financials did take a bit of a battering today, Reginald, and that's as investors get a bit jittery about their second quarter, half-year results. We saw fantastic figures coming out of the banks at the end of 2010, average growth rates above 30%. Are we likely to see a repeat?
Not really. What we are going to be looking at is something in the region, still double digits, but something in the region between 10 and 20 or 25. Basically, mainly due to one, cost cutting that most of them did during the first quarter, and the impact will be felt in the second quarter results. The banks did make some money on the forex side. So if you find your non-funded income should also show the signs of going up, which the side that will have taken the hit is their funded side, because of the interest rates going up, institutional investors also demanding higher rates for their deposits. That side of the business has been hit hard. So what you find is being factored in as actually maybe not even the quarter two result. People are looking in the long run. At the end of the year, where are the banks going to be?
Okay, and at the end of the year, obviously, the full impact of inflation would have taken its toll, and there's a real fear that loan books are going to suffer, and where people did come in and ask the bank for borrowing, there could be some defaults, especially at a corporate level. Is that an alarmist picture?
Not really. If you look at the largest lending that the banks do is actually to the agricultural sector and to the manufacturing sector, little bit to the household sector. You find the household sector is a sector actually that does not default that much, but most of those loans, as much as they are unsecured, they are on a check-off system, so the company is deducting straight from the salary. Your agricultural sector that has been hit hard by a drought, and the next rains we are really waiting for is it September, October, November, to come in. So this whole period, these guys are actually in a fix. So loan books will be dented on that side of the loan book, on the agricultural side and the manufacturing side. And we might actually see some tightening of credit into the market.
What about the investment strategy of some of these banks? Because really they make up the bulk of investors in the government securities and bond market segment. And we're told that at the moment there seems to be some kind of a sell-off. They're not very convinced about the CBK being able to manage inflation going forward, and subsequently reducing that volatility and depreciation of the currency. And as a result, many don't really want to be in shilling-denominated assets.
Yes, if you look at the current situation, the people that were in dollar-denominated assets have benefited close to, 15% on the dollar year to date. And you'll find with the new rules that central bank have given on the overnight window, their lend of last resort, most banks are now relying on rediscounting their treasury bills back to the central bank so that they can meet their cash ratios. The interbank rate currently, I think as of yesterday, was around 10.7%, which is actually way higher than the central bank rate. So if someone borrows from the central bank, they can easily go lend it into the intermarket rate. So that liquidity crunch that the banking sector is feeling will eventually have an effect on the economy and on the stock exchange and other assets that are there.
Talk to us about TransCentury, because, you know, a bit of a disappointing performance, not really meeting that introductory share price. What's got investors holding back? Why is the enthusiasm waning?
You see, in the current market conditions, the market sentiment is bearish. So if you're introducing your shares in a bearish market, you don't expect a lot of enthusiasm on it, which is the same fear that I will hold for the British America IPO. that there is no excitement in the market. The sentiment and the outlook for the market is so bleak. So if you look at TransCentury, if you look where they're invested in East Africa Cables, they're invested in agriculture, they're invested in a railway company which has not started making profit, they're invested in transport and in construction. All these are long-term investments. And currently we have a larger number of short-term investors in the market who normally drive these IPOs and these share introductions. So when an investor looks at it, they're saying, okay, as much as you might get in TransCentury, you only start benefiting maybe a year or 2, 3 years down the line.